Good morning, everybody. It is Friday, July 19th, 2019, and let's talk the markets and what our game plan is here today, and then get out and enjoy the million-degree weather. So I'd like to start with Dividend Sleuth. I asked him to go over the REITs in our universe probably 6 or 8 weeks ago, and he has been working on quite a few things. He did a number of articles and SWOT analysis and has some major takeaways from the REIT sector. I'm not going to dwell on it today, but I want, if you're a member, to read his articles. If you're at Fundamental Trends, they're all getting posted this weekend, and we will have both sites caught up to each other 100% this weekend. He had 9 REIT takeaways, and one of the things that I think we should keep an eye on is what I followed up with, which was that most of the REITs are overvalued right now. And that is particularly dangerous because during economic slowdowns, real estate takes it on the chin, and then there's the knock-on effect of vacancies causing some loans to go bad, which knocks onto the banks, and then the banks have problems, and that follows through to the general economy. So when REITs are very expensive, we really should take notice and avoid what everybody said in 2005, 6, 7, which is that real estate always goes up. That's not true. It's never been true. Really, real estate has tracked inflation for centuries. Has not really been an outperformer relative to inflation. And that is just a point that people need to wrap their heads around. The biggest money in real estate is not in being a landlord necessarily, although that has been very attractive under the current tax code and recent tax codes. The biggest money in real estate has always been in redevelopment and development. So to give you an example of something that I'm looking at with my girlfriend and with a couple of investors, is that there are parts of Milwaukee on the edges of nice neighborhoods that are gradually turning nice, and we are looking at buying a building. We've looked at buildings in the 600,000 to 2.5 million range, and depending on how much, how big the space is, how much remodeling has to be done, whether or not there's a tear down, as is the case with a couple of school buildings that I've been looking at. You can do some really interesting things depending on, of course, location, which is truly what it's all about in real estate. So while you can squeeze money out of real estate if you're willing to be a slumlord, the big money is in redevelopment and development. And the regular tenancy types of real estate are subject to economic cycles. So it's been a decade since we've had a recession, actually longer. And if we get a recession in the next year or two, I think we should expect real estate to come back anywhere from about 20 to 30%. Could be a little less than that, I guess, but judging from incomes relative to rentals, and then something I talked about with Dividend Sleuth here, is that more and more people are able to work from home at least part-time, which means smaller offices, which means less office space needed for many commercial enterprises. So I think, given the way that the term structures are set up on their loans in general, and the fact that tenancy is at an all-time high right now, there really isn't much room for real estate to go up anymore. So I think there needs to be a pullback. I think it has to deal with the trends of the way work is done now. And commercial real estate in particular, I think, is pretty vulnerable. Everything from malls that need major redevelopments to office towers that are not in prime locations, or office buildings that are not in prime locations. There could be a significant pullback in the REITs. And I think that's important because a lot of people are in love with the REITs right now because they've been on a tear. But I think you are wise to be at least a trimmer in the REIT space and then wait for a better opportunity. I haven't really put much charting to this for you yet, but I will. I'm going to do a couple of articles on REITs myself, including the one that I like best right now, which is not in Dividend Sleuth's list because it wasn't something he was particularly looking for. But one of the companies on our list is in pretty good shape. And you'll notice that, he's not looking tremendously at commercial. You do have Boston Properties, which is office, and Simon, which is the malls. I think both of them are vulnerable significantly. The industrial REITs, I think, are going to be solid, mainly because there is such a shortage of new industrial space out there. As some of the car factories go out of business, there will be new spaces available, but that space seems to be pretty tight. And while it can come back a little bit, I don't think it'll get creamed unless we have a really, really bad recession. And I don't see that coming, not anytime soon. I think we get a shallow recession. Realty Income Corp, a lot of people in love with this one, but it's due for a pullback as well. Federal Realty Investment could be a pullback. The residential apartments, I think the way that you have to look at those is that rents are pretty maxed out right now, but tenancy will probably stay strong. So I don't see those having a huge setback, but I think there's limited upside. And I think that that's common throughout all the REITs is limited upside, and then certain ones are vulnerable. Public storage has been super interesting over the years. I wish I had got into that trend 5, 6, 7, 8 years ago. Somebody put me onto it, and I didn't get involved, and I really should have. So take a look at his articles and the ones that we have coming up. The REIT space is going to be very volatile from the standpoint that it'll be more volatile than it has been. Not that it'll be horrible, but the upside is limited from here. So just keep that in mind if you were starting to fall in REITs at this point because of what they've done in the past. They're near the end of their cycle. We've had some really great conversations in the chat room the last few days. I put quite a bit in there from fundamental trends and margin of safety. I've been taking the conversations back and forth. I wish there was a technological way for me to do that, but margin of safety, Seeking Alpha blocks that. So the chat over fundamental trends got a little bit exciting. Talked a little bit about Bitcoin this week, and I think we will have a significant discussion about Bitcoin soon because one of our companies that we look to says something that I've been saying, which is most cryptocurrencies are going to zero, but Bitcoin will probably survive and be the leader there. Might get all of the market share. I think probably most is the better answer. And it's still going to go down quite a bit in value. The reason being is that for it to be widely adopted, they're going to have to change how Bitcoin works. There's going to have to be a lot more Bitcoin if we're truly going to use it as a unit of exchange. And something to remember about cryptocurrencies. Barter economies have never worked. And cryptocurrency is a way of replacing cash with kind of an electronic barter system. And that just doesn't allow for growth. So there are huge limitations on what cryptocurrency can do, frankly, because it is largely backed by a lot of Austrian economist wannabes who just don't understand how the economy grows. They're tied to their balanced budgets, to their business cycles. And the reality is that they pull back on growth with things like austerity and super firm currency. You need gradual inflation. Otherwise, you just don't get growth. What we do have to control for, though, is the bubbles that are created because of lack of regulation, margin borrowing that gets out of control, and a tax code that really does favor the super wealthy over the middle class. So we have to take a look at those things that are way more important than the whole, fiat currency chant that these guys throw out there. Fiat currency is good. The dollar represents the strength of the full American economy. Not just gold, not just the budget, but everything. So for a country like the United States, we have a different set of circumstances than everybody else in the world. We have the best geography, we have the best economy, long-term for big economies. Not that we'll always lead in a particular cycle, but in general, we have the strongest economy. It's diverse. It would be tough to cause a depression in the United States, and it would take abject neglect from government and the central bank. They'd have to basically just say, a depression, we'll suck it up and wait it out. You know that they're never going to do that. We might get 2 or 3 quarters, maybe even a year or two of a downturn, but even with the financial crisis, they had us out of it in 2 years. So, let's really think clearly about how things have gone over the last 60, 70 years, and really over the last several hundred years. The world gradually gets better, and anything that is tied to the notion that things are getting horrible is probably wrong. The world is not ending. We don't need a replacement for fiat currency. Fiat currency is good if it's managed properly, but it'll have problems. The problems of fiat currency are nowhere near as big as the problems of cryptocurrency, which somehow, for being so safe, keeps getting stolen and doesn't promote growth. It simply is barter. And I don't think we really want to go back to a barter economy. Much more on that later. What we really want to talk about is asset allocation, how we'll play a summer correction if we get one, and what we're going to be investing in. So later today, subscribers will get the ETFs I plan to buy soon, and we're actually going to cover them now. As you know, most of us are 35 to 65% cash right now, having trimmed out on the last rally. If you haven't trimmed out, today's a good day to trim out as the market's up a little bit. I would not be surprised to see it turn downward near the end of the day. The new economy is where the future is, and in fact, where now is. And we will talk about somebody who talked about that recently. So let's cover some of the ETFs I want to own. Not right now, but at certain support levels and possibly at bottom fishing prices, but definitely at support levels, because I think we'll see that. And you'll get all those numbers here today. I will make the article public as well, but without the buy levels. So let's take a look at the QQQ. I have made this comparison over and over again to the spider. So since the financial crisis, the QQQ has outperformed the SPY by roughly double. Going all the way back, including the tech wreck, QQQ has still outperformed SPY. Why is that? It's because there is a secular trend, which is something that we pay attention to. It's part of our process. The secular trend is that technology is changing the world, right? And the QQQ is built better than SPY is built. I talked about old man stocks and grandpa stocks, old economy stocks and grandpa stocks about a year ago in an interview, and that is just something that is true. You must accept it, that certain industries are slowly dying, other industries are growing, and certain industries are facilitating the growth, and that's where innovation lies. And innovation is where we want to be. The QQQ is our large cap tool for being in the American market. 100 great companies. The QQQ, which is NASDAQ 100, is built on the new economy. And it's relatively diverse, but technology driven for sure. On this chart, I include the low volatility funds that have gained attention lately and everybody's favorite dividend investing. And what can we see? QQQ beats all of those handily. So while you can get some marginal benefit from the low volatility, that may just be transitory. That may not be a permanent trend. And in fact, volatility has tended to be good for smart investors. Warren Buffett talks about that all the time. Use volatility to build your positions in the companies that you want to own. So again, QQQ wins. So let's add the ARK Innovation Fund and pull out the low volatility. And we'll just go back as far back as we're allowed to because the ARK Innovation Fund is relatively new. But it's outperformed even QQQ in its 4.5-year history. Crushed the non-innovation funds. So let's throw these all in there. Who wins? Again, it's QQQ. It is ARK Innovation. And what's this? Semiconductors. Semiconductors are the backbone of everything that's really going on. So when you take a look at the holdings of these funds, you see what's in there. You know, software, cloud, and retail, consumer, Facebook, which has been choppy, Google, Cisco. These are the large cap tech names and consumer names and some healthcare names. This is where you want to be if you're an indexer, not in SPY. The semiconductors, you'll notice a couple names, Micron, NVIDIA. They're also in QQQ. NVIDIA's here. Micron must be lower on the list, but it's in there as well. One of the things I like about the semiconductor, this particular semiconductor fund, is that you have First Solar in here somewhere. Must be below top 20. But it does include a little bit of alternative energy. Applied Materials would be in that space. So this is a semiconductor fund that I like because of a little bit of alternative energy in there. It's not the best performing semiconductor fund. If you want something that's even more pure play, there's a couple out there. But I like this one just because I think alternative energy is one of the giant trends. ARK Innovation, of their 5 major trends that are out there, alternative energy is one of the 5, along with Bitcoin and cloud, biotech, and I'll think of the other one. But these companies here are on their A list. A lot of these companies are on our sustainable growth list as well. So we can trade some of these or buy long-term positions. Now, I like Spotify, but I don't love Spotify. The Chinese companies I get afraid of. Although Alibaba, which they must have sold down to below top 20 position, I love Alibaba. And I've been talking about Tesla as well. If you don't want to own Tesla shares, somebody mentioned that battery storage is one of the 5 platforms. I called it alternative energy, but it's the same thing. I'll pull it up at some point. Tesla, I don't want to get too much into. If you don't want to own actual Tesla shares and you'd rather just have it be part of a fund, you can definitely do that with ARK Innovation because they are pretty committed to this stock. They gave it a price target of 4,000. I gave Tesla a price target of 1,000 in the next 5 years. I mean, if it gets to 4,000, that's just, cherry on the sundae. So some of these companies are very interesting. CRISPR is on our sustainable growth list. NVIDIA is. I've been in and out of Twitter. I can't decide if I want to fall in love with it or not. I think they're going to turn it into a big deal. But right now, Instagram and Facebook really just dominate, although they're having problems monetizing now. Illumina, great company, just pulled back. They bought some on the pullback. Square, along with PayPal, which is probably in here. PayPal's on our list. Square is getting added. Stratasys, I was in years ago, made a bunch of money, then lost a bunch of money. 3D printing, it was difficult to invest in 3D printing because you didn't know who was going to win. The technology was very competitive, and you couldn't pick out a winner. It turned out that Stratasys ended up being one of the winners. I wish I had stuck with it. So, you take a look at these, and you go, interesting. Somebody asked about Zillow in the chat just now. They dominate the market, right? Their merger with Trulia, there's no competition for them. So we should look at their revenue numbers and see where they are at valuation, and then can their revenue growth continue to increase at an increasing pace? I don't think that it can. I think they are also going to have a limited window. So I don't know that this is a company that I personally want to own long term, but it's great as part of this portfolio, which they trade a bit, right? This is a managed ETF. They trade these stocks, buy them on dips, sell them on rallies. And so we're basically taking anywhere from 12% to a quarter of our portfolios and saying, you know what, you guys go ahead and manage our innovation basket. And they've done a good job. I don't think I'll go more than 12% when I do get back into this. But we'll see. If you want to be aggressive, you can. And then these guys also have some money in the biotech. So I pointed out CRISPR, Illumina, Vitae. So that's a way for us to get into a basket of biotech, along with QQQ, which owns the large cap biotech, right? Your Amgens of the world, your Gilead Sciences, Biogen is probably in here somewhere, without us having to pick out every single company. So a combination of indexing to the big companies in innovation, and then managing your small and mid cap and some large cap in the ARC fund, I think is a good blend. Conceivably, on big dips in the semiconductor market, we could overweight semiconductors by throwing 3, 4, 6% of extra cash in there. Stanley Druckenmiller, one of the greatest investors of all time, recently told people, hey, invest in the disruptors, not the disruptees. And that's something that I've been talking about. It's why I show charts like this, right? Your VIGs of the world are okay, but the whole chant about dividends doesn't always pay. A lot of these companies pay dividends too in QQQ, maybe not 6% dividends, but 2% dividends, which shows that they're throwing off cash, and their dividend growth rates are generally fairly high and sustainable. So while you may not get as big of a dividend, you're getting more of a total return. And if your money is in a retirement plan, what do you care how the money gets in there, right? Because you're pulling it out as income anyway. So you just want a bigger balance in your retirement plan. So Druckenmiller talks about go with the disruptors, cloud, which is one of our big themes with Amazon and Alibaba, right? It's both disruptive and defensive at the same time. That's pretty nice. So what's one of the things that's going to be disrupted? Clearly, it's going to be the energy sector. The heat waves that we're getting are taxing the energy system. We're going to need more and more electricity, and it's going to have to come from alternative sources. First Solar is a company I'm just going to throw out there. We need to buy it on pullbacks. What's one of the other funds I'm going to buy? Gold. Not actually the gold, right? But I wanted to show you these alligator arms. So gold stocks have trailed for about 5 years the price of gold, even though the price of gold's come down. Price of gold is drifting up. I think that gradually continues, although I don't see one of these huge monster runs. I think gold probably stabilizes $1,300, $1,400, $1,500 a share, which is kind of the bottom of the range it's on now. Very unlikely that it goes back to 1,000 or 1,100, mainly because of the consolidation in the gold sector. Barrick just bought another company today. So what happens to alligator arms? They eventually close, right? So even if this drifts up, this might go up much more rapidly. And that's what I'm banking on, as I think I want to own the GDX pretty soon. And when will it be time to buy GDX? Well, it needs a pullback. So I have limit orders down around here. This rally has been substantial. And I don't know that it'll come all the way back here, but it is due for a correction. It's overbought. The money flow has been going in lately. MACD is way high. If you change to the weekly chart, shows the same thing, overbought. Now, do I think it'll go all the way to oversold? I doubt it. You know, if this RSI number gets to around 50 and this price gets down to around 24, I'm probably adding this as a 3%, 4%, 6% position. Trade that we missed was Treasuries. Druckenmiller went in on this one, and I think a few of us did just a little bit of TLT, but not much. And the reason I don't get real excited about TLT is because I just think it's hard to trade, and there's limited upside. Although, look at this rally. That was a great rally. Avi and a couple other people that I know were very involved with this trade, and I think it's about over. They've been trimming up here. Some of the other traders I know have been trimming up here. And so the question becomes is, at what point do we reinvest in TLT? I think the answer is sometime in the first half of next year, but not real soon. But this is something to keep an eye on. If we really think that there's a recession coming, we want to get ahead of a bad GDP number. So we're going to need to anticipate a bad GDP number, which I think probably comes in Q1 next year. So maybe we get in towards the end of Q1 on TLT, but we'll watch this. But the pullback could be anywhere between, a little under 130 to a little above here. So this is the range, right about there maybe. Take a look at where some of these are going. So right in here is probably a good spot for TLT. Comes a little bit more apparent with a longer term chart, right? This is the Treasury rate. Will the Treasury rate go all the way back down close to, this is a 20-year Treasury. Will it go below 2% again? Maybe for a hot minute. But really what we need to do is see the 20-year Treasury drift up a little bit on optimism in the economy, and then have it come back down on pessimism for a recession. So right here, I just think this is a hard spot to be involved with TLT. Could it shoot up? Could everything fall off a cliff of the economy and make interest rates drop and the bond price go up? Could. I think you probably get a small correction here. And then you have to decide, is this your safe haven? In the past, it has been, but a lot of countries are backing off on treasuries. So will it be the safe haven again? Hard to know. But as I have talked about for 4 or 5 years now, slow growth forever is real. And I think that more and more people will come to realize that. The big money already gets it. They already understand that demographics is a 20, 30-year smoothing out and combination of smoothing out the big charts, but the short charts are going to be volatile from time to time. Technology, global debt. A lot of people talk about global debt being out of control, and it is, but it's not overwhelming yet. So out of control, but not overwhelming. It's kind of like that friend who's getting drunk, but they haven't quite hit the wall yet. They haven't fallen down and smashed their nose. They're getting there, but probably not yet. One more shot, maybe 2 or 3 more shots. So again, like to see this correct before we get involved. My guess is sometime in the first half of next year. And again, we will talk about cryptocurrencies more in the future. In the meantime, I suggest reading articles like this, and I will describe where I disagree with them, agree and disagree with them. Why don't we take a couple questions, and then we can go out and, try not to melt. Anybody have anything? Ted is busy right now, but he says he will be talking about our favorite SWOT soon. I'll actually do the analysis of the company, but he's writing the SWOT. Anybody got anything, or you just want to go and do something else? Going once, going twice. All right. Oh, there it is. All right. So let's take a look at Micron. Somebody asked about Micron. I don't even know what it did today. Good sell price today. Well, so here's the thing. I think Micron is turning the corner. I think they probably have a lot of upside to set new highs. When will those new highs be? I don't know. If you want to trim Micron because you bought it down around 30 where I suggested to buy it, certainly you could sell half of that position or a third of that position, even 2/3 of that position, depending on how much trading you like to do, right? Ultimately, if I'm right about quantitative tightening ending being a stimulus for a quarter or two, then we could get the big rally. But I don't think we're going to get a China deal anymore. And that's somebody else's question. I don't think that we're going to get a China deal. And I think ultimately the economy softens up by the middle of next year. Somebody asked about Google's involvement with China. That's a bullshit story. So, that's your zero hedge crowd. You could throw that stuff out. If you want, I'll tell you something. So remember last year, just going to throw out something about zero hedge if you're reading it. One, it's a piece of shit publication run by a couple of greedy guys who don't give a shit what they say. And they put in just enough financial information out there, which is all easy to get through your brokerage. And then they spin it. And then every third article is, conspiracy stuff, Austrian economics, bullshit. And they make a lot of money on it. The guy over at Seeking Alpha, who used to work with them, is the suspicion. We're not allowed to reverse engineer people and figure out who they really are if they're using an alias. But the guy over at Seeking Alpha, he almost always has an article trending in the top 10. Does anybody remember what his name is? It's Heisenberg, right? Heisenberg. The Heisenberg. That's not him. The Heisenberg. There we go. This guy. This guy used to be with Zero Hedge. I'm pretty certain. Don't want to say that definitively, but we can take it 99%. This guy used to be with Zero Hedge, and he quit because he thought the other two guys were schmucks. And he's very good at what he writes about. But again, a lot of it is lifted information, and he comments on it. I think that he has a better viewpoint. I think that he's smarter. and I think that he's worth reading. So of the whatever, I don't follow a lot of people in the media and press, a few hundred. This guy's on that list. If you like Zero Hedge, stop and read this guy instead. His website and what he's got on Seeking Alpha. Should we just wait out Antero? Yeah, at this point, if you have it in a taxable account and you want to take the tax loss, yeah, go ahead and sell it, and then make a decision if you want to buy it back in 31 days. But these natural gas stocks really just don't have much further to go to the downside. If you think they're going to stay in business, you keep them. And that is something to think about with all the oil and gas stocks is if you think they're going out of business, you sell them, right? But after they're down 50, 60, 70%, you just got to ask yourself a question. Do I double up or do I just wait it out for a couple of years? And I do think there's a huge bull market in oil coming. I just think it might be after the election. So, sometimes you just got to suck it up and actually be the long-term investor that we all claim to be. Other questions? Control 4. Oh, we don't talk about Control 4 in a while. This is one that we traded and made some pretty good money on. Why such a straight line? Somebody buying them out? I always thought that Amazon might buy them. Somebody clue me in. Are they getting bought out? I don't know. I'll have to take a look at this one. I don't know what's going on with them. I haven't taken a look in a while. I'll take a look. Yeah, somebody said Heisenberg's a good writer. He is a good writer. I think I'm a pretty good writer when I'm cranking. He's always cranking. He's really good. I mean, I try to be Kurt Vonnegut, and the reason I say that is because writing hurts. I mean, it's hard to write when it's, but you have these handful of people and it just oozes out of them. For me, it's a process. I think Heisenberg, I think it oozes out of them. Let's see here. I will check on Control 4. I don't know what's going on with them. Quick thoughts on Permian names. Yeah, the stocks that we've highlighted are the cream of the crop. And if you believe they're going to stay in business, if you believe that oil is not going to disappear overnight, if you believe that there's mergers and acquisitions coming, if you believe that there might be a conflict in Iran, you just hold on to them. And that's life. Somebody says CHK, ouch. Again, I will scold you for being emotional. Yeah. Yeah, it just doesn't make any sense. These companies have assets that are very valuable. And Chesapeake, on a rally in a bull market, can sell most of their oil assets and become a debt-free natural gas producer. Same thing with Encana. If Encana doesn't merge or get bought, they can just sell their oil assets and hold on to the Montney up in Canada. So it really comes down to understanding the companies, which we talk about all the time. Sometimes the market doesn't care. And the market can stay irrational a very long time, which is why when we scale into something, I say you do it over months and months, not days and weeks, because sometimes prices move 10, 20, 30% on you. So don't worry about those single-digit percentage moves. Look for those bigger moves. Chesapeake, yeah, they're getting their asses kicked. And we probably need to take a look at, we just own calls. So if it spikes up, we make money. If it doesn't, we lose a couple percent. Oh, yeah, I don't think any of these companies are going out of business. They might merge at prices we don't like or get bought out at prices we don't like, but yeah, these companies aren't going down. The companies that are going down are the really little companies because nobody's going to lend to them anymore. I have no idea about the drone incident in Iran, whether who's telling the truth, who knows. I think that we know that President Trump will say what he needs to say to make the point he wants to make. It could be him trying to ramp things up. Who knows? I told you that I think after Labor Day is the most likely time that we see the Middle East flare up, because we don't want to do it during the summer drive season. But there's such a gasoline build right now that, and drive season's already half over. I think I think if something's going to happen in the Middle East with Iran, it could happen anytime. So we'll see. Important enough to raise cash that we should sell dirties and oils. Well, so I have said sell proportionally, right? Pretty much across the board. Just trim everything. You don't want to sell your calls if you have them, because they're so underwater right now that if they spike up, and you get some of your money back, maybe get it all back. But I think we're really just looking to recover some of our 2020 call money, and we may not buy calls again on oil stocks until well into 2020 or 2021, if ever. The XOP, if that's part of your asset allocation along with several oil stocks, I think that I trim and this is where I've trimmed. I haven't trimmed my stock positions, but I trimmed XOP. Why? Because there are a bunch of companies on here I don't want. So while I have Pioneer, and I've talked about Conchal and Continental, which I don't own at the moment, but I own Pioneer, I own Devon. I think there's an argument to own Marathon. Chevron is the best of the majors, the American majors, if you want one. I don't want one. Diamondback is something to consider. I like Occidental because of the CO2 business, right? I look at these companies based on the businesses that they do, and I like Occidental because, one, I think them buying Anadarko was a good deal, and two, they're going to sell a lot of non-core assets, and three, that CO2 business is a big deal. We've talked about it a few times. So, in any case, so I'd be trimming XOP more heavily, or even getting out of it, and then keeping your stocks. And once again, remember, you don't have to make your money back where you lost it. That's an important lesson. So if I can turn my curve into this, I don't care how I do it. I'm not married to oil stocks. What's gone on in that market has surprised me. I've been surprised at the acceleration of the divestiture movement. It's way stronger than I thought it would get. And it's one of the reasons why I did this. It is clear to me that the world is changing faster than we thought it would change. And there's a lot of asymmetry. There's a lot of disruption. There's going to be a lot more volatility. And emotionally, it's difficult to deal with. So, sure, I'll chat. And we have to wrap our heads around that. So there are some big trends, and I've changed my entire investment firm to reflect that. That's a big financial risk for me, because I could just run around telling people, hey, I got some nice retirement investments for you, and I could raise millions and millions of dollars. So we'll see. Yeah, Bill Gates is is involved in CO2 capture as well. That's why I say, when you differentiate stocks in the oil space, Kinder Morgan and Occidental are big in the CO2 space. I've pointed that out. I don't pound the table on it too much, but it's important, and it's what differentiates them. One of the things that differentiate them. All right, let's finally call it a day and enjoy the weather if it's good by you, and if it's too hot, stay out of the heat. I'm actually going to go see a movie this afternoon with a girlfriend, because it'll be one of the few places that's cold. It's going to be 100 in Milwaukee with about 90% humidity, and it's supposed to feel like it's 115. and it is a sweat box. My air conditioning is not happy right now. All right, folks, take it easy. I will get this article out to you this afternoon before my movie, and with the buy prices. And if you are not a subscriber on the public side, probably Monday you'll get this article, but without the buy prices. So if you want to take a free trial and get the buy prices, hey, have at it. Love to have you on board. Take care, everybody.